Stop what you're doing. Right now. Yes, put down your phone. Close that other tab where you're checking silver prices for the 47th time today. This is important. Bank of America. The same Bank of America that's been in the precious metals business for longer than most of us have been alive, the same bank that paid a $920 million fine in 2020 for manipulating silver markets, just published a report saying silver could hit $309 per ounce. $309. That's not a typo. That's not clickbait. That's an actual scenario analysis from their head of metals research, Michael Widmer, published in early January 2026 and confirmed by Kitco News, Fastbull, Mining.com, and approximately 17 other financial outlets who apparently all read the same Bank of America report. Now, before you mortgage your house to buy silver bars, and trust me, someone watching this is already Googling home equity line of credit, let me show you the actual math behind this number. Because the math is fascinating, the math is beautiful, and the math reveals something most people completely misunderstand about how these price targets actually work. This isn't financial advice, this is a math lesson disguised as a silver video, and yes, there will be a quiz at the end. I'm kidding, there's no quiz, but you should probably take notes because what I'm about to explain is how professional metals analysts actually calculate these shocking price predictions that generate headlines. Spoiler alert, it involves division. I know, revolutionary stuff, but stay with me because the division gets really interesting. Let me start with the number everyone's focused on, $309 per ounce. According to Bank of America's Michael Widmer, as reported across multiple sources, including Watcher Guru and NAI 500, that's the theoretical peak if, and this is a massive if, the gold to silver ratio compresses to 14 to 1. 14 to 1 means it takes 14 ounces of silver to buy 1 ounce of gold. That's the ratio. It's not complicated. It's literally division. Gold price divided by silver price equals the ratio. Currently, the ratio sits around 59 to 1 according to Widmer's analysis. That means right now, you need 59 ounces of silver to buy 1 ounce of gold. Or looking at it the other way, gold is 59 times more expensive than silver per ounce. Bank of America's base case for gold in 2026? They're projecting $4,538 per ounce on average, according to their Monday report published early January. Some upside scenarios push to $5,000 or even $8,000 if investment demand surges. But let's use the $5,000 gold target because that's where the really fun math happens, and it's closer to Widmer's bull case scenario. $5,000 for gold. Divide by 14, you get $357. Bank of America rounded down slightly to $309, probably using a slightly different gold price assumption or accounting for some friction. The exact number doesn't matter, the methodology matters. They're saying, if gold reaches $5,000 and the ratio compresses to 14 to 1 like it did in 1980 during the Hunt Brothers silver squeeze, then mathematically silver would trade around $309. That's the whole forecast. That's the entire analysis. Historical ratio compression applied to projected future gold prices equals theoretical silver peak. Now here's where it gets hilarious. Bank of America also gives a more conservative scenario. $135 per ounce. Where does that come from? Same math, different historical ratio. In 2011, during silver's last major rally, the gold to silver ratio compressed to 32 to 1, according to SD Bullion's historical data and referenced in multiple Bank of America analyses. Take that same $5,000 gold price, divide by 32, you get $156. Bank of America's published figure of $135 suggests they're using a slightly lower gold price for this scenario, maybe $4,500 or thereabouts. Again, the exact numbers shift based on which gold price you plug in. But the methodology is identical. Historical ratio times projected gold price equals silver price target. This is not revolutionary market analysis. This is not secret Wall Street algorithms. This is literally multiplication and division. A smart 10th grader with a calculator could replicate Bank of America's entire silver forecast if you gave them the gold price assumptions and historical ratio data. And yet. This report generated headlines across financial media for a week. Bank of America's staggering silver forecast. Historic call. Breathtaking metals forecast. It's arithmetic. Slightly fancy arithmetic with historical context, but arithmetic. Now, before you think I'm dismissing this analysis as useless, I'm absolutely not. The math is simple, the implications are not, and understanding why Bank of America chose these specific historical ratios tells you everything about what they actually think is happening in precious metals markets. Let me show you why 1980 matters and why 2011 matters, because those aren't random dates. Those are the two most extreme ratio compressions in modern precious metals history, and Bank of America citing both of them is actually a pretty bold statement about current market conditions. 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They accumulated massive physical positions. They took delivery of futures contracts. They drove silver from around $6 at the start of 1979 to a peak of $49.45 per ounce in January 1980, according to historical data. Gold during the same period peaked around $850. Do the division. 850 divided by 49.45 equals approximately 17. But at certain points during the squeeze, the ratio briefly touched 14-1 as silver spiked faster than gold. That 14-1 ratio lasted maybe weeks, maybe days, depending on which specific prices you measure. It was the absolute peak moment of the most dramatic silver squeeze in modern history. It required two billionaires literally trying to corner the entire market. And even then, it triggered COMEX to change rules mid-crisis, implement position limits retroactively, and force liquidation that crashed silver back down. When Bank of America says silver could hit $309 if the ratio returns to 14-1, they're essentially saying, if we get another event as extreme as the Hunt brothers squeeze, here's the math. That's what the number represents. Is that likely? Well, let's just say Michael Widmer didn't title his report, Silver Definitely Hitting $309. Everyone panic buy right now. The actual title, according to Kitco News and Fastbull, was Gold will be the primary hedge and performance driver in 2026. Silver could top out between 135 and 309. Could top out. Between. These are scenario brackets, not predictions. Now let's talk about the other number, $135, based on the 32-1 ratio from 2011. 2011 was different from 1980. 2011 wasn't a manipulation scheme. 2011 was the peak of a genuine bull market driven by post-financial crisis anxiety, quantitative easing, inflation fears, and massive retail investment demand flowing into silver ETFs and physical bullion. Silver peaked around $48 in April 2011. Gold peaked around $1,900. 48 into 1,900 gives you approximately 40. But at silver's absolute peak relative to gold during that cycle, the ratio compressed to 32-1 briefly. That ratio lasted longer than 1980's 14-1, maybe several months in the low 30s, and it occurred in a more normal market environment without billionaires trying to corner supply. When Bank of America uses 32-1 for their $135 scenario, they're referencing a bull market ratio that's extreme, but actually happened in modern markets under relatively normal conditions. That's much more plausible than 14-1. Not guaranteed, not certain, but plausible if you get another sustained precious metals bull market like 2010 through 2011. So Bank of America is giving you two brackets. The plausible but extreme scenario at $135 using 2011 ratios, and the technically possible but would require historic squeeze conditions scenario at 309 using 1980 ratios. That's actually pretty honest bracketing for a Wall Street forecast. They're not saying silver will definitely hit either number. They're saying if this historical pattern repeats, here's the math. But here's what makes this interesting in January 2026. Michael Widmer isn't just citing historical ratios for fun. He's citing them because he thinks current market conditions might actually support ratio compression. And that's where the forecast gets meaningful. Let me show you what Bank of America actually says about why the ratio could compress, because this is where the simple math connects to real market fundamentals. According to Widmer's analysis reported across multiple outlets, the current ratio around 59-1 is well above the long-term historical average. Bank of America expects gold to perform well as a hedge and alpha source in 2026, but they explicitly call out silver as having even more explosive potential for investors willing to take higher risk for extra upside. Translation: they think silver is underpriced relative to gold compared to historical norms. The ratio is stretched, and if gold rallies, silver should rally harder and faster, compressing that ratio. Why would silver rally harder than gold? Bank of America points to several factors in their analysis according to the Silver Industry Substack and multiple other sources. First, silver has both safe haven investment demand like gold and massive industrial demand from photovoltaics, electronics, AI data centers, and electric vehicles. Gold is almost purely investment demand. Silver serves double duty. Second, silver's market is smaller than gold's by total value. That means the same dollar amount of investment inflows moves silver prices more dramatically than gold prices. Higher volatility, higher beta, bigger percentage moves in both directions. Third, according to Widmer's analysis, silver investment positioning is relatively modest compared with gold, leaving room for large capital inflow if sentiment swings to precious metals. There's capacity for money to flow into silver without the market being overcrowded. And fourth, industrial demand is structurally rising due to the green energy transition and technology sector growth. That's not cyclical demand that disappears in recessions. That's secular trend demand that persists regardless of economic conditions. Put all that together and you get Bank of America's thesis. Gold is the primary hedge and steady performer, but silver is the higher risk, higher reward play that could significantly outperform if precious metals continue rallying. The ratio compression scenarios, $135 and $309, are just mathematical expressions of that outperformance thesis using historical precedents. Now, let me address the elephant in the room that everyone's thinking. If Bank of America really believed silver was going to $309, wouldn't they just buy all the silver themselves and print money? Yes, they would. That's exactly what they would do. The fact that Bank of America published this as a research report rather than quietly accumulating silver tells you everything about probability. These are scenarios, upper bounds, theoretical possibilities, not base case expectations. Widmer's actual language, according to the reports, is careful. Silver may appeal to risk-tolerant investors. It could outperform gold. Prices could peak between 135 and 309 if the ratio compresses to historical lows. May, could, if. These are conditional probability statements, not predictions. But here's what's genuinely interesting. Bank of America felt the scenarios were probable enough to publish and defend in their 2026 metals outlook. That's different from some random YouTuber saying silver's going to the moon. This is a major bank's research division putting specific numbers in writing with their name attached. They could have just said silver looks attractive and left it vague. Instead, they ran the math on historical ratio compression scenarios and published $309 as an outer bound. That tells me they think the probability is non-zero. Maybe 10%, maybe 20%, definitely not 50% or they'd be buying, but not zero. And in markets, non-zero probability of extreme outcomes is what generates volatility and opportunity. Let me show you why the ratio matters more than absolute price predictions, and why understanding this makes you a smarter precious metals investor than 90% of people watching silver content. The gold to silver ratio is mean reverting over long time periods. It oscillates. The 20th century average was 47 to 1 according to historical analysis. The 19th century average under bimetallism was 15.5 to 1, currently 59 to 1. That's above modern averages. Not absurdly above, but elevated. If you believe gold is going higher, which Bank of America clearly does, projecting $4,500 to $5,000, and you believe the ratio will revert toward historical averages, then mathematically silver must go up faster than gold. That's not speculation. That's arithmetic. If gold doubles and the ratio compresses from 59 to 47, silver more than doubles. The math is automatic once you accept the ratio reversion thesis. Bank of America is essentially saying, we're bullish on gold for fundamental reasons. If you accept our gold thesis and you add belief in ratio mean reversion, the math implies silver outperforms. Here are the numbers if you take ratio compression to historical extremes. That's actually a pretty elegant way to structure the forecast. They're not predicting silver in isolation, they're deriving silver targets from gold targets using ratio analysis. It's a relative value argument. And relative value arguments in correlated assets are often more reliable than absolute price predictions because you're betting on relationships rather than levels. Now let me address the comedy inherent in this entire situation. Bank of America, the bank that paid $920 million to settle charges of precious metals manipulation in 2020 according to Reuters and Bloomberg, is now publishing wildly bullish silver scenarios. The irony is so thick you could cut it with a silver knife, if you had a silver knife, which you probably can't buy right now because premiums are 40% over spot, but that's a different video. For years, conspiracy theorists claimed major banks were suppressing silver prices through massive short positions in futures markets. Whether that's true is debatable and legally litigated, but the optics of Bank of America now saying actually silver could go to $309 is genuinely hilarious. Either they've completely changed their positioning and gone long, or they're publishing research that contradicts their trading desk, or the manipulation theories were always overblown. Pick your narrative. All of them are funny in different ways. My personal theory? Bank of America's research division does actual analysis and publishes what the models say. Their trading desk does whatever makes money. Those two groups probably barely talk to each other. Welcome to modern banking. But the fact that this forecast exists and carries the Bank of America name is significant regardless of their internal politics. When major banks publish bullish precious metals research, that influences institutional allocation decisions. Money managers read these reports. Pension funds read these reports. Sovereign wealth funds read these reports. Even if you think Bank of America is evil or manipulative or whatever, their research still moves markets because other institutional players take it seriously. That's how the ecosystem works. Now let me show you the practical takeaway from all this math and history. Because if you've watched this far, you deserve actual useful information rather than just entertainment. If you own silver right now, Bank of America just gave you mathematical frameworks for thinking about potential upside. Not guarantees, frameworks. Under a 2011 style bull market with ratio compression to 32, $135 is the math. Under Hunt Brothers extreme conditions with ratio at 14, 309 is the math. You can use those frameworks to set targets, plan exits, manage risk. You don't have to believe they'll happen, but knowing where those levels sit helps you make informed decisions if silver does rally. If you're thinking about buying silver, Bank of America just told you they see explosive potential relative to gold, but specifically for risk-tolerant investors. That's code for this is volatile, could go way up, could also correct hard, Don't bet money you can't afford to lose. That's actually useful honesty. They're not saying everyone should own silver. They're saying if you have risk appetite and believe in precious metals, silver offers higher potential returns than gold with higher volatility. And if you don't own any precious metals and think this is all nonsense, Bank of America is telling you that major institutional research divisions are modeling scenarios where silver quadruples from current levels. You can dismiss that if you want, but you should at least know it's happening. The math is published, the scenarios are documented, the rationale is explained. What you do with that information is your choice. Here's what I find genuinely fascinating about this Bank of America report beyond the headline numbers. The methodology they're using, historical ratio analysis, is both incredibly simple and incredibly powerful. Anyone can calculate these numbers. I literally showed you the math in this video. 5,000 divided by 14 equals approximately 357. 5,000 divided by 32 equals approximately 156. That's the entire model. But very few people actually run these calculations and think through the implications. Most people see silver price prediction and either believe it uncritically or dismiss it as hype. Almost nobody stops to ask, where did that specific number come from and what assumptions drive it? Bank of America is forcing you to think about the gold to silver ratio. That's valuable even if their specific targets don't materialize, because once you understand ratio analysis, you can track it yourself. You can watch whether the ratio compresses or expands. You can make your own judgments about whether current levels are sustainable. You stop being dependent on forecasts and start understanding the mechanics. That's education. That's actually useful. And here's the part that makes me slightly respect this forecast, despite my general skepticism of bank research. Widmer explicitly called this a scenario analysis, according to multiple reports, not a prediction. He gave you two different historical precedents with different ratios and let you decide which seems more relevant to current conditions. That's intellectually honest. He didn't say silver's definitely going to $309, trust me, bro. He said if we get 1980 level squeeze conditions, here's the math. If we get 2011 style bull market, here's different math. He showed his work. Compare that to YouTube silver channels, and yes, I'm aware of the irony saying this in a YouTube video, that just scream silver to the moon with no methodology. Bank of America at least gave you falsifiable scenarios based on historical data. You can agree or disagree with whether those historical patterns will repeat, but you can't say they didn't explain their reasoning. Now let me address the biggest question you should be asking. Not will silver hit $309, but rather, what would have to happen for the ratio to compress to 14-1? Because that's the real forecast buried in Bank of America's analysis. They're not primarily predicting a silver price, they're predicting potential ratio compression. The silver price is just the mathematical output. What drove the ratio to 14 in 1980? Extreme supply shortage caused by manipulation. Physical demand overwhelming paper supply, industrial users competing with investors and speculators for limited metal, and panic buying as price momentum attracted more capital. What drove the ratio to 32 in 2011? Massive investment inflows into silver ETFs, retail mania in physical coins and bars, post-financial crisis distrust of fiat currency, quantitative easing expansion, and industrial demand recovery from the recession. Bank of America, pointing to both ratios, suggests they think elements of both situations could manifest. The physical supply tightness of 1980 combined with the investment demand surge of 2011. And if you've been following silver markets in late 2025 and early 2026, you know there are legitimate supply concerns. China's export restrictions, effective January 1st. Structural deficits for 5 consecutive years. COMEX inventory depletion. Industrial demand acceleration from AI and solar. Bank of America sees the same data everyone else sees. Their scenario analysis is essentially asking, if supply tightness intensifies and investment demand accelerates, how far could this go based on historical precedent? The math says, really far. $135 to $309 far if you hit historical extremes. Now I'm going to say something that might surprise you. I think Bank of America's $135 scenario is actually more interesting than the $309 scenario. 309 requires Hunt Brothers level extreme conditions. That's spectacular but unlikely. 135 requires 2011 level bull market conditions. That's extreme but actually happened in modern markets without manipulation. And here's the key. We're currently at what, $80? Call it 80 for round numbers. 135 represents a 69% gain from current levels. That's huge but not insane. That's within the realm of normal bull market moves for a volatile commodity. 309 represents a 286% gain from $80. That's not a bull market. That's a mania. That's a once-in-a-generation event. If I had to bet, and I'm not giving financial advice, I'm just talking probabilities, I'd say Bank of America thinks 135 is maybe 20 to 30% probable. 309 is maybe 5 to 10% probable. And something between current prices and 135 is 50% probable. But they can't publish a research report that says silver will probably go up some amount between now and whenever. That doesn't help anyone. So they give you the bookends using historical frameworks and let you calibrate your own probability estimates. That's actually useful research structure. The problem is media coverage turns it into Bank of America says silver going to $309, which misses all the nuance and conditionality. But that's not Bank of America's fault. That's the financial media doing what financial media does, simplifying complex analysis into clickable headlines, which, to be fair, is exactly what I did with this video's title. So I'm part of the problem. Hi. Welcome to YouTube. Let me close with the thing that matters most. Understanding this Bank of America forecast makes you a better precious metals investor, not because it tells you where silver is going, nobody knows that, not even Bank of America, but because it shows you how professional analysts think about the market. Ratio analysis, historical precedents, conditional scenarios, probability brackets, that's the framework. That's how you think about uncertain outcomes in a structured way. You can apply this methodology yourself. Watch the gold-silver ratio. Track whether it's compressing or expanding. When it hits extremes historically, that suggests mean reversion opportunity. When gold rallies but the ratio stays elevated, that suggests silver is lagging and might catch up. When both rally and the ratio compresses, that's confirmation of bull market dynamics. This is free alpha. This is the kind of analysis that hedge funds charge 2 and 20 for, and Bank of America just published it for anyone to read. The $309 headline is the marketing. The ratio analysis is the actual product. If you walked away from this video understanding how to calculate the ratio and why it matters, you got more value than from any silver price prediction. $309? Maybe, maybe not, probably not, but possibly. $135? More plausible, still conditional, still requires bull market, still not guaranteed. 80 to 100 over the next 12 months. Bank of America didn't explicitly say this, but that's what their gold forecast and current ratio imply. If ratio stays elevated, that's probably their actual unstated base case, but they can't publish silver might go to $100, we think, maybe because that's boring and useless, so they give you the extremes and let you fill in the middle. That's analyst communication. That's how the game works. Now you know. If silver hits $309, I will film myself eating this HP 12C calculator. That's not financial advice. That's entertainment. Don't eat calculators. Don't invest based on YouTube videos. Do your own research. Understand the math. Make informed decisions. And if you learned something about ratio analysis and scenario modeling from this video, consider that more valuable than any price prediction. Bank of America didn't predict the future. They showed you mathematical frameworks for thinking about possibility. That's actually better, because you can use frameworks forever. Predictions expire immediately. Now you know the math behind the headline. Use it wisely.